Last year, Klarna charged retailers 6% on every pay in 4 sale. That's 3 times what Visa takes, and $1.6 billion in fees. Pay in 4 was sold to you as 0%. The markup got passed back in the price. Let's walk the dominoes. So the first thing to understand is how a payment app that markets itself as totally free makes money. The answer sits in Klarna's filing with the Securities and Exchange Commission earlier this year, ahead of the company's public listing. Page after page of the filing breaks down where the $2.8 billion in 2024 revenue came from. And the largest single line, by a wide margin, is the cut Klarna takes from the store. When you tap Pay in 4 at checkout, Klarna pays the store the full purchase price that same day. The store hands you the product. You owe Klarna 4 installments over 6 weeks. The store cares about one thing, whether the money hit the account today, and Klarna confirms it did. The store ships the order, and that's the first domino of the chain. What the store doesn't tell you, and what Klarna doesn't print on your receipt, is what the store paid Klarna for that service. According to Klarna's own merchant fee schedule, Pay in 4 costs the retailer 30 cents plus 5.99% of the purchase price. On a $100 order, that's $6.29. The store keeps $93.71. Compare that to the same $100 order paid on a Visa card. The average Visa interchange rate in the United States is 1.81%. That same $100 order costs the store about $1.80 in card fees. Klarna takes more than 3 times as much. And the store agrees every single day on every Pay in 4 sale in the country. The question is why any retailer would agree to pay 3 times more for a payment method that ultimately settles the same way. The answer is a number from a Stripe study published in 2024. Stripe ran a controlled checkout test across 150,000 sessions on its own merchants. The result was that businesses offering Pay in 4 saw up to a 14% lift in revenue. Higher conversion at the cart. Higher average order size per customer. Affirm publishes its own number, and its merchants report an 85% jump in average order value when consumers pick Pay in 4 over a card. Klarna's own case studies are bolder. A clothing retailer called Rue 21 saw a 73% lift. A furniture chain called Relax the Back saw a 149% lift. So the math is simple from the store's side. The store pays $6 to Klarna, then collects $40 more from the customer than it otherwise would. The store walks away with $34 more profit on a single transaction. The 6% fee is a rounding error against the order size lift. That's why retailers signed up. That's why Klarna processed $105 billion in gross merchandise volume in 2024 alone. But here's where the story changes. Klarna's 6% doesn't disappear into a black hole that only the store has to think about. The store has to recover that fee somewhere. The Richmond Fed published an economic brief on the buy now pay later market last year. The brief found that roughly 1 in 3 retailers passes the higher Pay in 4 processing cost directly into their base prices. Not as a surcharge, not as a line item, but straight into the sticker price. The shirt that used to cost $40 is now $41.20, regardless of how you pay for it. That's the part almost nobody outside of academic finance papers has explained out loud. If you walk into a Sephora and pay in cash, you're now paying a small markup. That markup exists specifically to fund the Pay in 4 shoppers at the same store. The same applies to a Best Buy customer paying with debit. And it applies to the older customer at a department store who has never used a Pay in 4 app in her life. The Pay in 4 shopper got the interest-free credit. The cash shopper paid a piece of the spread. You might be wondering why this isn't regulated. Partially, the answer is that it is. 3 years of investigations have opened at the Federal Trade Commission and the Consumer Financial Protection Bureau. But the merchant fee structure itself sits in a regulatory gap. Klarna isn't a traditional bank, and the rules that apply to Visa and MasterCard interchange don't apply to it. The follow-up rulemaking has been stuck in comment periods ever since. The number is $1.6 billion. Not in stimulus, not in damages, but in merchant fees. That's 57% of Klarna's entire 2024 revenue, collected one transaction at a time from American retailers, and ultimately funded by every customer who walked into those retailers regardless of which payment method they used. Call it the 6% skim. It's the cleanest example of price discrimination in modern American retail, and most people don't even know it's happening. But the 6% is only the first slice. Klarna built 3 more revenue layers on top of it, and one of them is the exact thing Pay in 4 told you it would never charge. Actually, the merchant cut is only 57% of Klarna's revenue. Pay in 4 isn't the only product on Klarna's app. Pay in 4 is the funnel. When you open the Klarna app or tap a Klarna checkout button, you see Pay in 4 as the prominent option. 4 interest-free installments, No fee for the consumer, the whole pitch. What's not as prominent is a second product called Klarna Financing, which offers longer-term plans of 3 months, 6 months, 12 months, and 24 months. Those plans charge interest, sometimes at annual percentage rates above 30%. According to Klarna's filing, interest income from those longer-term financing plans generated $675 million in 2024. That's 22% of total revenue, bigger than late fees and bigger than advertising. The second largest revenue line in the entire company is the thing Pay in 4 was supposed to never be. The mechanism here is the Upsell Ladder. You start with a $30 order on Pay in 4. Klarna learns your spending pattern, your repayment behavior, and your card. The next time you check out a higher ticket item, like a $500 couch or a $2,000 laptop, the app changes its pitch. Klarna pre-selects a financing plan with monthly installments, sometimes stretched to 12 months. Sometimes the interest rate is buried in a small disclosure line on the third screen of the checkout flow. Sometimes it sits in a footnote. The consumer who got comfortable with the 4-installment habit doesn't always notice the math has changed underneath. So that's the upsell ladder. Layer 1 is the merchant cut. Layer 2 is the interest the consumer pays on the longer plans. Layer 3 is the late fee on the Pay in 4 product itself. And this is where the numbers get sharper. Klarna charges a late fee of $2 to $8 per missed payment in the United States. A 7-day grace period applies, and a maximum of 2 fees can hit each order. The published rate sounds soft, but the aggregate revenue tells a different story. According to Klarna's filing, late fee revenue across all products totaled $254 million in 2024. That's 9% of the company's revenue, collected from the consumers, usually the youngest ones, who couldn't make a payment on time. The Consumer Financial Protection Bureau has been tracking this exact pattern. The Bureau's January 2025 report found that the 18 to 24-year-old age group has the highest delinquency rate of any cohort using these products. Roughly 5.7% of borrowers in that band end up in default or charge-off status. Younger shoppers carry fewer assets and less financial cushion, and the payment app defaulted them into a credit structure they never had to apply for. Layer 4 is the part most people skip past entirely. Klarna sells advertising inside its own app, specifically the merchant placement panels and search results inside the Klarna shopping interface. In 2024, that retail media business generated $180 million. That's 6% of Klarna's revenue, from a product category that didn't exist on the company's balance sheet 5 years ago. Merchants who want premium placement pay an extra fee on top of the 6% rate they already pay. 2 charges from the same merchant on the same transaction. Adding the 4 layers together gets you to $2.8 billion in 2024 revenue. The breakdown sits at 57% merchant fees and 22% interest income. Consumer fees take 9%. Advertising takes 6%, with a smaller remainder from card interchange on Klarna's branded debit card. The full company is up 24% year over year. That's the first annual profit in 5 years. Here's the cleanest way to see it. Out of every dollar of Klarna revenue in 2024, 57 cents came from the store. The rest splits in pieces. Interest on longer plans takes 22 cents, late fees 9 cents, advertising 6 cents, and card interchange 3 cents. 3 of those lines, the interest, the late fees, and the card interchange, get paid directly by the consumer. 12 cents of every Klarna dollar comes from the user the company markets to as a beneficiary. And the 4 layers still aren't where the largest pool of money sits. Every Pay in 4 loan has to be funded by someone, and the people funding it have been quietly absorbing your retirement savings into the pipeline. Turns out, Klarna doesn't actually hold most of these loans on its own balance sheet. When Klarna fronts the store the $100 for your Pay in 4 sneaker order, that's a $100 loan sitting somewhere. Across the entire company, Klarna had 94 billion Swedish kroner in customer loans on its books at the end of 2024. That's not a balance sheet Klarna wants to keep growing forever. Holding loans means absorbing default risk. The risk eats earnings, and earnings drive the company's valuation. So Klarna does what every consumer lender does at scale. It packages the loans into financial products and sells them to outside investors. The industry term for the structure is the forward flow pipeline. In the simplest version, Klarna agrees to sell every Pay in 4 loan that hits its books for the next 12 or 24 months. The buyer is a specific institutional partner, and the price is pre-negotiated. The loans flow off Klarna's balance sheet within days of being written. The cash comes back to Klarna, the next batch of loans gets funded, and the cycle repeats. Affirm, Klarna's nearest competitor, has been openly running this playbook since 2020. According to Affirm's investor disclosures, the company has issued more than $10 billion in asset-backed securities across 20 separate offerings since the program launched. Recent transactions include a $777 million deal backed by unsecured consumer loans. The forward flow buyers named in Affirm's filings include the Canada Pension Plan Investment Board, Liberty Mutual Insurance, Prudential Financial, and Sixth Street Partners. More than 120 institutional investors participate in the Affirm note offerings. Klarna runs a similar pipeline through its banking subsidiary in Sweden. The loans get bundled and either held on the bank's balance sheet or sold into the European securitization market. The end consumer of a pay-in-4 loan, in other words, is rarely Klarna. It's a pension fund, an insurance company, or an asset manager. Each gets told the paper offers higher yields than a corporate bond of comparable duration. The pitch frames the borrowers, younger and smaller ticket and faster turn, as a diversified pool. The bond gets bought, the retirement fund holds it, and the dominoes keep falling. That brings us to the consumer side. The Consumer Financial Protection Bureau released a report in January 2025 examining who uses pay-in-4 and how, and the findings are bleak. Roughly 63% of pay-in-4 borrowers originated multiple simultaneous loans during the year. 33% took out loans from multiple pay-in-4 providers at the same time. The borrowers most engaged in this loan stacking, as the Bureau calls it, tend to be the ones already showing signs of financial stress. That looks like higher credit card balances, more delinquencies on other accounts, and lower buffers. And here's the part the regulators are most worried about. Klarna doesn't typically report pay-in-4 loans to the consumer credit bureaus, and neither does Affirm or Afterpay. A consumer can be running 4 pay-in-4 loans simultaneously across 4 different apps. Each of those 4 lenders has no visibility into the other 3. The Bureau's report estimated that 18% of pay-in-4 borrowers carry at least one delinquency on another credit account, compared to 7% of non-borrowers. 9% of pay-in-4 borrowers are delinquent on a credit card, against 3% of non-borrowers. The risk profile is meaningfully worse than the average consumers. The lender doesn't see it. For now, the system holds. The 2023 charge-off rate on pay-in-4 loans was 1.83%, within the band of acceptable consumer credit losses. The 2022 rate was 2.63%. Both numbers sit below where the auto loan asset-backed securities market sat in 2023. They sit well below the subprime mortgage delinquency rates that triggered the 2008 crisis. The pipeline isn't broken yet, but the global pay-in-4 market is roughly $560 billion in gross merchandise volume as of 2025, growing 14% a year. The user base sits around 380 million people globally and projected to reach 670 million by 2028. Inside that growth, the cohorts most engaged in loan stacking are also the cohorts with the weakest household balance sheets and the least credit bureau visibility. When the next consumer credit cycle turns, the losses don't sit at Klarna or Affirm. They sit at the bonds in your pension fund and the insurance company that wrote your auto policy. And the auto loan market was supposed to be the safe one. The same pension funds holding pay-in-4 paper already hold $3 trillion in subprime auto loan bonds. Same machine, bigger scale, already breaking.